Well, Mark, it is officially 2024. I'm only 24 years old still, and you're
Wow.
still 60, right? So I'm getting
Yeah,
younger
something like that.
and you're getting
Something
better
like that.
looking.
Oh, that's true. That's for
But
sure.
we
Just joking.
but we had a great 2023. For those of you who have not been following along, this is the Closing Bell podcast, your weekly recap of all things economic news, markets, hot topics, whatever it may be. We are here to bring it to you live in a fun, insightful, and thoughtful way. So, if you haven't been listening to anything we've done, I encourage you to one episode to go listen to would be our 2024 outlook. It does a deep dive into policy, rates, stocks, bonds, alternatives. It was a real fun one to do with you. Um,
That's
but
great.
2024. So how was your Christmas? How was your New Year's? Before we get into our recap here, anything fun or insightful that you did?
Wow. No, had family over, all you guys, and that was amazing for Christmas. And then just nice to enjoy Christmas together as a family, and get to spoil all my grandkids, my wife and I, Jana. It's that's the best part. You kids are you're okay, but the grandkids are at a different level, bro. So that's just being honest. That's super fun, but that was great. And then New Year's. Can't believe it's 2024. I mean, what a blessing to be in this time, in this place. It's 2024. It's crazy to think about how fast time has gone, but here we go. It's exciting,
Yeah.
and New Year's was great. My team won. I mean, I went played at SC, but I'm rooting for that Pac-12 teams, right? So UW, where where
Yep.
my son-in-law Josh played, and as you know, and Lauren. So we that was super fun just to see them. So anyway, it's going to be big. Michigan, Washington. Looking for that game next week. So anyway, yeah, great time. Love being together, and love celebrating. Love the holiday season. But I already got my lights down, dude. We're moving forward. It's a new day. We're Christmas was over. Tree was down, and we're on to the new year. So it's a good time.
Great. Well, it is a new day. It is 2024. Markets in general have had a little bit of a pullback in the first week of trading since the new year started. And if those of you watching here, we got kind of a recap of the markets from the last 3 years, 1 year, and then down to daily. So we'll kind of break that down, and also for our listeners, we'll break it down for you so you can kind of follow along here. But basically, you look at the past year. Great year in the green for the major four indexes. Obviously, NASDAQ led the way at over 37%, which was actually quite a bit higher because if you look at year to date, we're actually down almost 3.5 in the NASDAQ. But S&P finished up over 21%, and the Dow Jones finished up, over 11.25%. So year to date, though, again, we're down. So Mark, what do you think? We've talked a lot about this. Year to date, I mean, we expected volatility in 2024, especially with the great second half of the year. I think the last 41 trading days of the year accounted for a majority of the gains in the S&P 500. So
Oh
we had a
wow, yeah,
killer end of the year, blowout, end of the year. So why do you think,
yeah,
and what do you
amazing.
think is going to happen in the first quarter of this year as we move forward here?
Who knows? I mean, honestly, I wish I had that crystal ball, but we don't know. But we're not surprised. I think we've talked about the fact that markets just from the beginning of late October, beginning of November have just skyrocketed. All of that, it wasn't unusual. We talked about that going into the year, Christmas rally. October. Everybody remembers October from '87 crash, but we called October as actually the bear killer, and actually waited all the way to the end of October and the last days, and
Yeah.
then all finally the market kind of turned around, and then it was just like straight up. We had the Magnificent Seven last year that really led the way. The AI leaders, the big companies, tech companies that are just killing it,
Mhm.
with the new AI
Yep.
anything to do with AI. We saw that theme last year for sure. What was encouraging about the year, though, as it ended, is that it started to broaden out. We had those 7 stocks led the way for most of the year in the Nasdaq, and then by the end of the year, we really had the broadening of the market, and so lots of companies were participating in that roll up. And so we had a nice move there. And then, if you look at charts, and we don't have time to look at directly charts, but because of that, not unexpected, as you get into a new year where you have some profit taking, you're not paying taxes on these things until next year now, if after January 1st. So, I think a lot of people have taken some money off the table. And with the prospect of, for that reason, because they've had such big gains, taking those gains early this year, possibly, and then, seeing how the year plays out. So Nasdaq's taking a hit, 3% down so far this, just in this week. So, but Dow's actually held in there pretty well. So you're seeing some of the. I was looking at Verizon. I was looking at some other stocks this morning. Stocks that did not do very well last year, and all of a sudden they're all, they're looking more positive. Big dividend payers, that maybe this will be the year of dividend payers really begin to shine, because last year it became about growth mostly. So anyway, it's going to be fun. We've always talked about the fact that, with the Christmas rally, with this year, not surprising, we had that run. And then on top of that, when Powell in the mid-December basically indicated that they were done hiking rates, that aggressive Fed tightening the last 18 months or so was going to end. And that was a huge bump in the markets as well. And so, the bond market responded, the interest rates dropped, probably got a little bit ahead of itself, had a little bit of, increase in rates beginning of the year here too, which might coincide with the sell-off, especially in the growth stocks. So it's all those combinations. And we've been talking about the fact that this next quarter is going to be very interesting to see how the consumer responds, and begins to really tighten their belt as going forward. But, we'll see. That's going to be really interesting. Don't think it's going to be a big drop in spending, but we should see some type of pullback in consumers now as the new year progresses. So that's how we've looked at it and been talking about it for quite a while now.
Good points. And speaking of the consumer, I think that brings up a good opportunity to talk about the latest job report. And I don't want to bore anybody out there, but I mean, as goes the consumer, so goes the rest of the economy. So it's really important to look at these jobless numbers, the amount of jobs added, which specific sectors. There's a lot at play here. And even if you look at the numbers, on the hood, and then you take a peek under the hood, there's actually some decent evidence showing the significant slowdown, and not cause for worry or panic, but cause to take a pause and look at, okay, where is this going to go? Where is this going to go from here? So we'll kind of break it down. So basically, if you add the public and private portions of the economy together, we added 216,000 jobs in December alone. Now, excluding the government jobs, we added around 164,000 to payrolls. It's still healthy, but it's slowing down from what we've seen historically this past year, and even dating back to pre-pandemic levels as well. So we're slowing down a little bit. So one thing we want to look at, though, is the government jobs added. So on the screen here, if you're watching on YouTube, or even if you're just listening, I'll break this down for you here. So this chart is from the Bureau of Labor Statistics, and this is a 12-month net change in jobs added in specific job sectors. So again, the jobs report seems like we still have a strong labor market, still tight labor market. It's still showing that, the Fed, based off of this, they're probably going to be holding rates higher for longer, literally, like we've been talking about. The market, as of recently as of yesterday, priced in 6 rate cuts in 2024, which is more than the 3 that basically Powell came out and said that they were looking at, and how that's kind of plotted out on their dot plot for the year. So So let's talk a little bit about this. So if you see here in the pink, it's private education and health services, which is government dominated. Healthcare is government dominated. That had the highest number of net job growths by December of this past year. Second was government jobs added. And then third was like the lower wage, kind of more vocational leisure and hospitality sector. Think about waiters, waitresses, sectors that might fluctuate a little bit more depending on the time of year. But I think what's concerning and something that again has caused me a reason to pause and look at, okay, well, we added a healthy amount of jobs. But if you take a look under the hood, most of them were dominated by government jobs. So government payrolls grew by an average of 56,000 each month in 2023. 56,000,
That's
more
amazing.
than double.
Yeah.
More than double the average monthly gain in the previous year. So you're getting big government. You're getting a bigger government in terms of jobs being filled in the government, more government workers. How are you going to pay these government employees? Well, you need more private sector workers, right? To basically be able to tax them and utilize the tax revenue against the salaries being paid to the government workers. So right now, I think it's a 3-to-1 ratio. Private sector employee to government worker, and that's not nearly enough. I saw that as an interesting stat this morning. So, Mark, any thoughts on that? Like, what do you think moving forward? I mean, is this sustainable? It's definitely
It's not sustainable. We can't have a government. You can't have more private. You can't have more public jobs. Over private. I mean, it's just silly, and it's just where we are in our current administration. I mean, the government's growing by leaps and bounds, and the private sector. If you look at manufacturing across the board over this last year, there's definitely underneath the surface, there's lots of places where it shows that the economy is slowing and having in the private sector having a tougher or the public sector having a tougher time with the economy. Yep. So anyway, just this will be interesting, and part of the reason this might all play out this year in the election. So it's an election year. We'll see how this goes. It's going to be interesting to see how that how it plays out. So government, private education, health services. Yeah, we need all those things, but you can't have government jobs growing that much. Those monthly numbers you gave us just absolutely incredible. So we'll see how that plays out. I think that's part of the frustration of the average worker, that's out there. So, they're working their tails off and you need them, they're paying the taxes. So it's just a tough situation. So let's see how that plays out. I think that just tells a lot because these numbers just came out this week. So, and it's part of the reason the markets have sold off a little bit because it looks like on the surface that the job numbers continue to be expanding and, cause the Fed, maybe they won't won't drop rates like they said they would in December. But again, underneath the surface, it's not as good as it looks. And you've made that point in this graph.
Great insight. So this kind of leads us to the Fed, interest rates, which leads us to fixed income. And that's kind of the main topic, the last topic that we want to touch on. Provide some really key points for you to think about moving forward, especially this next quarter and this year of 2024. So I just love saying the word 2024. It's the year of the Mamba. It's Kobe, right? 24. It's going to be a Mamba mentality year. We're going to crush it. We're going to achieve our goals and hopefully have a wonderful year in the markets. Again, all positive thinking. So anyway, so Mark, I think we got to break these two charts down, which again, there's two charts on the screen here. We'll break them down verbally for you as well. But let's talk about the Fed and how this is going to kind of trickle down again to the fixed income, to cash, even money markets. So like you said, on the surface, it looks like we have a healthy labor market, still tight labor market. People that are leaving jobs are taking a little bit longer to get back to jobs. It's hard to bring them off the sidelines. The labor participation rate fell. I think there was around 1.5 million jobs lost, like full-time employees actually lost this year. So there's mixed data, basically, is what I'm trying to say. But overall, the Fed's looking at it going, don't really need to cut rates as of yet. We're in a wait and see pattern. So if you're a fixed income holder, but first, before we go into the fixed income in terms of how it affects or is affected by the Fed dropping rates, why don't you talk to us a little bit about that top chart there, about all the
Yeah.
cash that's sitting on the sideline? I think that's
All
really
right. So
key.
this is an amazing graph. This shows basically going back to 10 plus years, 2007. Looking at how much money is in money market funds and in cash in currently, and you see here that look at that to the far right. Obviously, is the most recent data to 2023. We've almost 5.84 trillion in cash, investors that have their money sitting in cash, which is incredible amount, almost $6 trillion. I heard recently it's even closer to six, which it's basically $6 trillion in cash, which is an enormous amount of money. It's interesting. You and I were talking about when that spike started happening. 2018, we started going up, and then you see 2020, that last peak, cash peak was right a few months after COVID hit, right? And you see there that actually the last
months
when
after,
that peaked, this graph just shows that the S&P 500 at that time actually had hit a low. So one way to look at this graph is to say, hey, typically when people are fearing afraid and they're scared, or they want to just be in cash. I mean, how many people we talked about say, hey, I just want to put my money in CDs, I can get 5+%, or well, and that's all, it's legit, right? So you get higher amounts of income, or higher amounts of a rate of return in cash. So that's more attractive. And we haven't had that for a long time. And that's part of the, big part of the reason here, is that it's okay to be in cash right now, because I can get 5+% and, without any risk. And so I get that. That makes total sense. But I also show that typically when you have high cash levels like that, that tends to be, the contrarian in me, is the other part is usually is shown to be a place when the markets actually can really, move, especially if that money starts coming off the sidelines into the various markets. So I just think that's a really incredible, I think it's just important to show this to our listeners, that how much cash is on the sidelines, and let's, talk about where that, and what, does it stay there, or, what's it look like if you start to move out? And in fact, if interest rates, like Powell talked about in December, you just mentioned, they factored in 3 interest rate cuts this next year. You just mentioned that, some are indicating maybe as much as 6 interest rate cuts. That means if you can get cash, returns right now at 5.25, that means a year from now, if they have that many cuts, you might be at 4.25 in a year. So you'll still get a decent amount of money, but short-term interest rates will possibly in 2024 drop fairly significantly if in fact rates go down, like many anticipate that happening. So what does that mean? So so your return on cash has been good. If interest rates start dropping, you start getting less money on your cash. And I guess that leads into the next slide. Basically, is in the past history, as that cash investment goes down, this is an opportunity now for, if cash is moving off the sidelines, this idea of core bonds, U.S. stocks, different places, especially in the core bonds. We want to focus on that one today. Is that if interest rate, short-term interest rate starts to go down, your cash returns go down. However, if that money is put into the what we call the aggregate, bond, a core bond fund that's currently paying 4.7% roughly on average. If interest rates go down 50 basis points, your cash return comes down, but in the bond market, actually, if it comes down 50 basis point, your capital appreciation goes up, as much as 3%. So you might lose money in cash returns if rates come down, but in your bonds, you'll actually get the 4, and if it's 4.7 and you get another 3, you're looking at 7.7 to 8% returns over the next 12 months. See, so it's opposite of cash. Bonds actually, that inverse relationship, as rates come down, bond yields, bond appreciate, goes the other way. So this just shows core bonds, in the past, after there's a window of opportunity where, when they basically stop hiking rates, you can see that over the next number of years, 1 year and even 3 years, core bonds, in the past have been up as much as 10% in the next year. And over the next 5 years, average 7%, well above the cash level. So all that to say
That's
is
year
that
over year.
that's year over year. Correct. Yeah. That's a year over year percentage, which is just, incredible opportunity. So all that to say is that, if you're sitting on cash, there's a lot of things to be concerned with, but there's an opportunity now in fixed income, that it looks like, again, if interest rates continue to go down and if the economy slows, it could be really beneficial having money in those fixed income opportunities. So something to be thinking about, and something that I'm super excited about. I mean, we talked on our year-end review that we're looking at the S&P 500. Remember, what was our return? I mean, we're looking at maybe based on, and we don't know. I mean, we're just looking at P ratios
Mid-single
and
digits.
earnings. 7.5 to 8% return on the S&P 500. Well, I mean, if that scenario just plays out like I just talked about, your core bonds, will have a minimum of 8%, and if it's even goes lower than we talked about, I mean, it could be even more significant, 10, 15. So anyway, just think that core bonds have a real opportunity here, especially. So something to think about for those who have money on the sidelines now. That's something that you don't get these opportunities very often. And so it's something to be thinking about and take advantage of.
Excellent points there. And just for our listeners and viewers here, I mean, we're not saying, oh, you have to dump everything in core bonds. I mean, there are people that are hesitant or scared. I mean, there's been countless news articles coming out saying the market's going to crash 80, 90%, which we don't want to feed too much into the fear and the clickbait that it could be. Again, say it enough times, it could be right? But I mean, in terms of what we're seeing now, that seems very far-fetched. And again, as data comes out and we can look at it, we can kind of see how that plays out. But again, the consumer is still holding up quite resiliently at this point, which basically they account for around 70% of total GDP. But again, if you're nervous and again, you can't shake the nervousness, you went through some rough times in 08 or COVID or whatever it may be, now might be a great opportunity to exchange the equity risk premium, which we talked about it being very narrow at this point, right? Comparative to a core bond total return potential of 10% if rates get cut, which I want to show a really interesting 100 basis point chart here on bond convexity in a second. But maybe it's just an opportunity to, if you want to just kind of see how the year plays out, you can be in core bonds or have a diversified bond portfolio that we've talked about and get some decent equity-like returns, which is, like you said, has not always been the case.
Yeah. And you can do so with a third of the risk of the equity market. So you're talking about lowering your risk and at the same time getting really nice returns. So yeah, and we're hearing, and we always get the people that are, anticipating the big disaster and the big drop, and if we go into a deep dark recession, again, all those situations, kind of indicate that interest rates, they'll have to begin cutting interest rates pretty significantly to build, to grow that again, to at least, lower interest rates to expand the economy and get people spending. That's all really beneficial for fixed income. So, just something to think about. Been talking to clients about, that idea, those who are kind of nervous. And it goes back to that point too. Last thing is the 60-40 portfolio. It hasn't, that idea of diversification, having a growth with income, kind of where you got a good portion of your portfolio longer term in stocks, because longer term stocks have outperformed bonds, but in the shorter term, that 40%, I think is going to be a really significant part of total returns for 2024 and even 2025. Those rates come down.
Good points. And that 60-40 blend, speaking of what you were just talking to, this is going to, drive your point home here, is that after the Fed rate hike ends, a 60-40 blend 1 year later does about 14.2%. And then year over year for the next 5 years, 8.4%, which for a growth of income portfolio, which you would think middle of the road and risk tolerance, is fantastic. It's great, especially if you're
Yeah.
pre-retiree, soon to retire, or newly retired. I mean, it's a great way to get income. Again, higher interest rate or higher coupons, excuse me. Dividend payers, you're getting all of that. So for total return potential, that is quite excellent. So good points
Yeah.
there. I do want to touch on one more thing here before we go. And it goes back to your points on, if the Fed cuts rates, here's the returns. So the chart 4 here on the bottom right-hand corner of our page that we're showing here, First Trust, one of the fund companies that we use and we look at, along with Capital Group and a lot of others that provide us a lot of good insight into what these people that are way smarter than us see, and they can do all the math. Chart 4 is really interesting. So you look at, this is a chart just showing like an asymmetrical return profile with shorter duration and longer duration bonds. So you look at a 2-year treasury down to a 30-year treasury on this, and what the current yields are. So 2-year 4.26 current yield, 5-year 3.85, 10-year 3.89, 30-year over 5%, 4.05%. And what would happen if the Fed raised or cut rates, and what the 12-month return would be based off of those decisions. So we'll kind of go line item by line item. And again, I want to drive this home because I think it's very fascinating. So if you're in a 2-year treasury on average, let's say your duration's around 2 years in your bond portfolio, and the Fed raises rates again, all of a sudden inflation comes back and the Fed raises it 1%, which is 100 basis points. You're still holding in there at positive 2.4%, even if the Fed raises rates a little bit more. So again, as we say, like shorter duration bonds or bills, money markets, or ultra short bond funds, they tend to do better if you're expecting rates to rise, right? Because they can capture those rates, preserves a little bit more capital. But again, you kind of lose the total return potential. But then you start going out 5, 10, 30 years. Look at those orange bars right there and how it affects the total return by increasing rates by 1%. So 5-year, it loses about 0.5%. Whatever, that's not that bad for the following 12 months. 10-year though, negative 4.17, and a 30-year. If you're a 30-year treasury, you're down almost 13%, which is like equity. That's a bad year for equities. So on the flip side of that, we look at 12-month total return if the Fed decreases rates by 1% or 100 basis points. Okay. And this is kind of the environment that we could see ourselves in 2024 if data persists to show that we can do that. So a 2-year treasury, your 12-month total return, 6.19%, 5-year treasury maturity, 8.17, 10-year, 11.67. And if you own a 30-year and the Fed drops rates by 1%, 20.25 over a 12-month. That's fantastic. That's really good. That's equity-like returns in most of these categories here. So, Mark, so your point, right? Exactly. I mean, it's good if you can do this and extend duration, that total return potential. We haven't seen this, and you probably remember the last time it was like this, right?
Well, the orange part happened in 2022. I mean, basically when we had a 40-year off year in fixed income, right? I mean, we just saw this happen where rates increased significantly and what the bond market and what happened to the bond market. Now, since we're on the other side of that now, the question is are rates going to go up further from here, or are they going to go down? And what we just talked about is fact is based on where we are, it looks very likely that rates will be dropping. Powell and the Fed have talked about that. They said they're done with hiking rates and they're going lower. And so we don't know how much lower, but the fact is they're going lower, according to them. And that's why now you look at the blue that you just had up, and that's the opportunity. And that's why sitting in cash, as the rates go down, you're going to get less and less return on your cash. But as rates go down and you're in fixed income, whether it's a 2-year or 5-year, some type of duration curve that you have your portfolio in, you have opportunities to make money, a lot of good returns in fixed income. So that's the difference, and that's where we think that cash begins to come off the sidelines and into those fixed income areas, and eventually into equities too, if you continue to run. But we just think fixed income looks really good this year.
Absolutely. And
That's a
obviously
great
there's some
chart, by the way.
sectors yeah, it's a really good one to look at. And obviously there's some, being selective in equities is a great thing to do for 2024. Get outside the Mag 7. Obviously there's great companies, and if you can buy in, if there's, a downdraft in the market and pick up some of these companies at potential discounts or below,
Yeah.
fair market value or what estimates are, then great. But also at the same time, industrials, healthcare, besides the AI sectors, those are going to be really transformative stimulus going into like kind of industrials, infrastructure, things like that, where there's been a lot of money pumped into that sector. You should start seeing companies with higher revenues, higher earnings per share, blowouts in those kind of categories, where those are some interesting places to kind of look this year as we move
Yeah.
forward. But
Yeah.
off my soapbox now.
Yeah, good stuff. Good information. I think it's we'll see how it plays out, but that's what we're thinking here at Boyer Financial. And I like that chart. I think it shows kind of that point. We're going to keep hammering that point home again, because I think in the fixed income market, it's definitely a window of opportunity that I think we need to take advantage of. So we're going to try to do that.
Awesome points today, Mark. Thanks again for everyone who watches and listens. Subscribe on our YouTube channel. Follow us on your dedicated podcast channels. We love talking to you. Stay up to date. Visit our website. We got other podcasts, Move the Chains, which can be kind of more topical or more inspiring. That's kind of our more free-flowing questions, see where the conversation goes, unscripted, which is super fun as well. So follow along with us. I don't want to talk like Yoda, speak everything backwards. But we love everyone. Have a great weekend, and we will see you next week. We're out.
See ya.